The Intelligent Investor, by Benjamin Graham, is a timeless classic that provides invaluable insights into the world of investing. Graham, widely regarded as the father of value investing, offers practical advice and strategies for investors to navigate the unpredictable world of the stock market. The book begins by distinguishing between two types of investors: the defensive investor and the enterprising investor. The defensive investor, lacking the time, interest, or expertise in analyzing stocks, is encouraged to opt for a simple, low-cost, and diversified approach to investing. On the other hand, the enterprising investor is advised to undertake a more active, research-intensive approach to identify undervalued stocks and achieve higher returns. Graham emphasizes the importance of conducting a thorough analysis of a company's financial statements and understanding its intrinsic value. He introduces the concept of Mr. Market, an imaginary character who frequently offers to buy or sell stocks at varying prices. Graham advises investors to take advantage of Mr. Market's irrational behavior by buying when prices are low and selling when they are high. In the book, Graham stresses the need for a margin of safety when purchasing stocks. He argues that investors should only buy when the market price is significantly lower than their estimate of the stock's intrinsic value. By doing so, investors protect themselves from losses and increase their potential for long-term gains. Another key concept discussed in The Intelligent Investor is diversification. Graham advises investors to spread their investments across different companies and industries to minimize risk. He advocates for a careful selection of stocks based on in-depth analysis rather than blindly diversifying. This approach allows for a balance between potential returns and risk reduction. In addition to stock selection, Graham advises investors to determine their risk tolerance and select an appropriate asset allocation strategy. He discusses the benefits of both bonds and stocks, highlighting their contrasting features and risk profiles. Graham recommends a combination of the two asset classes based on the investor's risk appetite and financial goals. Throughout the book, Graham also explores the psychological aspect of investing. He delves into the pitfalls of emotional decision-making and how it can lead to poor investment choices. Graham cautions against following the crowd and succumbing to market fluctuations, urging investors to maintain a disciplined and rational approach. Furthermore, Graham introduces the concept of market cycles and the inevitability of fluctuations. He advises investors to adopt a long-term perspective, emphasizing the importance of patience and perseverance. Graham suggests that by focusing on the underlying value of a company rather than short-term market movements, investors can weather the storms and achieve successful outcomes over time. In the later chapters, Graham provides insights on how to navigate different market conditions, including defensive strategies during bear markets. He discusses various investment vehicles, such as mutual funds and index funds, and their advantages for individual investors. Graham also warns against excessive speculation, offering guidelines on when to exit an investment that no longer aligns with one's investment objectives. Overall, The Intelligent Investor offers a comprehensive framework for investors to approach the stock market with caution, discipline, and a long-term perspective. Graham's teachings remain highly relevant and applicable to investors of all levels of experience. By emphasizing the principles of value investing, sound financial analysis, and psychological awareness, Graham equips readers with the tools necessary to become intelligent investors capable of achieving long-term financial success.